Good morning. Happy Friday morning from the Asia Pacific, just half an hour away from the opening bell in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Rebecca Choong Wilkins.
Our top stories today. Asian stocks are under pressure as traders sift through mixed earning reports ahead of the U.S. jobs numbers. The dollar is steady as Treasury Secretary Scott Bessent says he favors a strong currency.
Now, Bessent also defended President Trump's tariff plan, telling Bloomberg that China's economy is the most unbalanced in the history of the world.
I think especially that China now, given all their excess capacity, will, no matter the level of the tariffs, will end up eating quite a bit.
And we have more on the trade war just ahead, with Chinese retailers now getting hit by duties and Hong Kong's status as a global financial hub facing fresh threats.
Good morning. Welcome to the show. Hope you're all well. Final trading session is just a couple of minutes away, and we are headed into the weekend. Well, in terms of just a longer-term view and momentum, certainly some upside when you look at some of the moving averages. 4 weeks of gains, as we point out, bottom of your screens. Although the price action for today going into the open, do expect this to permeate in the first few minutes or so, is really one of weakness across the region here. Asia Pacific, we're down about, give or take about, well, let's call it flat right now. Let's wait for this to really get warmed up, because this might really have some bearing on what happens in Hong Kong, depending on which way we open. It's worth pointing out as well, so, yep, we are in the thick of earnings season in the U.S. Europe had a substantially good day yesterday, up 1 to 3%, depending on where you look right now. So we're down about a third of 1%. So we're just coming off on futures right now. We did hit a record, though, on the benchmark overnight. Okay, very quickly, let's have a look at FX markets right now. So the dollar is actually softer, all things equal, for about a fourth straight day. Rate decision, of course, coming out of the Bank of England yesterday. Certainly markets are, in terms of positioning, certainly on the more dovish side of things right now. We're also looking at dollar-yen. Yep, you're reading that correctly, 151.28. So we're now at about the strongest level there in close to 2 months, so about early December levels here on dollar-yen. Specifically, nothing much to tell you about as far as the Chinese currency is concerned. In fact, as I just mentioned, that flipped the boards in commodity markets. The renminbi fix has almost been like watching paint dry this week, almost at a similar level for 2 or 3 straight sessions as well. Brent, this is really a tariff story as well. A third week of losses and weakness in the oil price. We're putting this down to 2 things, right? One, certainly would be the stockpile conversation. Second would be the tariff weighing on the growth outlook as well. Now, this is one specific commodity we don't normally look at, manganese, over in China. We're up 2.5%. Massive day yesterday. And a lot of that might have to do with the fact that, again, it might be a tariff conversation. Well, we'll talk about this a bit later on. Wheat is at about a 3.5 month high. And, of course, we're looking at rubber futures also seeing some substantial upside of late. So, yeah, a lot of idiosyncratic stories here to tell you about. But, yeah, Rebecca, it's really all about tariffs, what it means for the growth outlook, particularly with these, the news we were just talking about earlier on, right? These shipments from Hong Kong, Puma, limiting some of the sneakers that they now are shifting, are exporting from mainland China to the U.S. It's really part of this broader geopolitical tussle.
Yeah, that's right, Dave. And we are sticking with this theme of tariffs coming up next. U.S. Treasury Secretary Scott Bessent has defended President Trump's new tariffs on China. He says they're only designed to ensure fair trade. Bessent also dismissed these concerns that the levies will be inflationary for the U.S., telling Bloomberg that China will pay the higher price. Just take a listen.
China is the most unbalanced economy in the history of the world. And they are in a deep recession right now. They're experiencing deflation, and they're trying to export their way out of that. And we can't allow that. We want fair trade. And part of that is taking a strong position on the currency and the terms of trade.
But what about the inflation concerns that are stemming from the tariffs and tariff threats?
Look, I'm not sure that where this narrative that tariffs for the country putting on the tariffs is inflationary, that we could have a small one-time price adjustment, that as we saw in Trump 1.0, that the deregulation and the other policies, we stayed right around the Fed's target level. So I'm unconcerned about that. I think especially that China now, given all their excess capacity, will, no matter the level of the tariffs, will end up eating quite a bit.
There's a lot of uncertainty around tariffs. We see them threatened or signaled, and then they're taken back. It appears as if this administration might be unfriendly to businesses. Is that right?
Really? I think it's just the opposite. I think this is the most pro-business administration in history. And everything we are doing is going to increase the after-tax return on capital. And as a result, working Americans will have very high real wage growth. That what we've seen over the past 4 years is the government and government-adjacent sectors providing the employment growth. And why have we experienced this affordability crisis? First, there was a massive spending met by increased regulation, which caused inflation. And then government and government-adjacent jobs do not cause real wage growth because they move up at CPI. So, I think that we are going to not only be business friendly, but very, very friendly for working Americans.
Yeah, there we go. That was Scott Bessent, of course, speaking with our colleague Saleha Mushin. And really, on the back of the tariff conversation, it's also markets were attuned to his comments on the relationship that we will likely see. That's an open question between the U.S. Treasury and the Fed. You look at the Treasury curve right now. I should also mention we're going into the jobs report later today in the U.S. Plus, of course, not on your screens, but I can tell you the break evens, for example, on the 2-year, we're still about 3%. So that's at about 21, 22-month high. Maybe goes into the conversation coming out of Lori Logan talking about how maybe the Fed might not even need to cut interest rates. We also asked, in fact, the Treasury Secretary about their relations with the Fed. Have a look.
One of the things I wanted to emphasize is that we are not focused on whether the Fed is going to cut, not cut. What we are focused on is lowering rates. So we are less focused on the specific of rate cuts and how do we get the whole curve down. I mentioned that the 10-year, I believe, is the important price to focus on. It's mortgages, it's long-term capital formation. So, and look, I think with the president's policies of energy dominance, deregulation, and non-inflationary growth, I think that the 10-year is going to naturally come down.
Christopher Condon, who leads our Fed coverage, joins us from Washington today. Chris, thank you for joining us so late in your time as well. We heard from the Treasury Secretary there. There's certainly a nuance that markets need to be aware of between the influence of the Fed in the short end and perhaps what they can do as far as the long end is concerned. Help us understand what those comments there coming out of the U.S. Treasury Secretary.
Sure. Well, I'm happy to be here, David. Well, first of all, the first thing I want to say is that this is a bit of a switch. There was something unexpected from this administration. In the first Trump administration, we saw a lot of basically hammering the Fed, calling on Jay Powell and the Fed to lower interest rates. So it's a bit of a pivot to hear Scott Bessent absolutely saying, we're not going to put any pressure on the Fed. I'm not going to talk about monetary policy. Rather, this administration is focused on real interest rate or market interest rates. Of course, he's thinking of the impact that, say, the 5- and 10-year treasuries have on consumer markets, on the housing market. And if you were able to bring those rates down, then certainly that would provide fuel to the economy. Of course, the Fed has been lowering interest rates. It has not been feeding through until the past couple of weeks to the long end of the curve. It is now a bit. My reaction in the end is, in terms of the administration seeking to bring, the mid and the longer end of the curve down, that's easier said than done. It's not a very easy prescription to follow.
Chris, tell us also what Bessent said about the Treasury employees working on Elon Musk's government efficiency team and whether he's done enough to assuage some of the concerns there.
Sure. Yeah, that was right at the top of the interview. This has obviously drawn a lot of criticism, a lot of controversy with the access that's been given at Treasury to the government payment systems to these DOGE personnel. So Bessent started off by saying, look, first of all, these two people that are involved are now Treasury employees, and they're involved in what he called sort of a procedural, or he called it operational review, not an ideological review. He stressed that they have read-only access to the systems, meaning that they can't change the code, they can't tinker with the system, he said. And he also, interestingly, got himself into a bit of trouble, I have to say. He kind of personally vouched for these folks. He said they're highly trained professionals. They're not a roving band, sort of messing around with government systems, and that he had personally been part of vetting these folks. Well, within hours, actually, one of them has resigned. The Wall Street Journal has reported that one of these individuals who was at Treasury has been linked to a social media account that's been posting blatantly racist and hateful things, and that person has now resigned, at least from DOGE. So that's a bit of a self-inflicted embarrassment, I would have to say, for the Treasury Secretary. Of course, there's no suggestion that he knew about that, but it is a bit of an embarrassment.
Bloomberg's Christopher Condon there, who leads Bloomberg's Fed coverage in Washington. And still ahead, Societe Generale's Wei Yao joins us to look at the tariff impact on Asian economies and what Trump aims to achieve from the trade war. And we're counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. This is The China Show. Well, a busy end to the week here, Dave. It started as we came back for onshore trading, things were a little bit more muted, a little bit more downbeat, but now we are seeing a rally coming back into Hong Kong stock markets. There was a little bit of whiplash through the week, but now looks like we may be heading for our fourth week higher. On the HSI, we're nearing that 2100 level. That's the level that just on your screen there, 21,000, excuse me, that you can watch there. And again, this very high mainland turnover that we're seeing in stocks. Elsewhere, a little bit of corporate news. We had Yum China gaining as much as 10% in the US trading overnight. That's off the back of some strong earnings results, stronger than expected comparable sales, stronger restaurant margins. And China Renaissance, this is a story actually coming out of Taixin reporting, citing sources here, gosh, what a tongue twister, about Baofan. So this is the founder and chairman of China Renaissance. He may face prosecution for suspected bribery. A lot of folks really watching that case. We haven't heard much about Baofan or really much clarity about his whereabouts for the last couple of years. And then finally, this big CGB sale. These are coming back, of course, after this extended break that we've been having. We are now also entering the window for quite a bit of data, and that includes foreign reserves data. We also might see sort of CPI numbers coming through on Sunday as well, I believe it is. Yeah, so don't call it a weekend unless you cover this economy. CGB sale, just to, I guess, to break that down, to 137. There's a one-year bond sale, and there's also a 30-year bond sale. I think it's 30-year bonds of 30 billion yuan, tongue twister, of 30-year bonds. Yeah. It's Friday, we're going to get there. This Friday, obviously. There's also tariffs, which we haven't talked about just yet. Wei Yao is with us, head of research, chief economist for APAC at SocGen. Good morning and nice to see you. I guess we got to start with the Donald Trump's favorite word in the dictionary here. What scenarios have you guys gamed out on tariffs and how that impacts the various scenarios on growth for China?
It's, I think this week showed, there is a wider range of possible scenarios here, given, what has happened. But to us, the central scenario remains that by the end of the year, we're going to have 10 to 20% tariff on China, meaning that the current 10 could go down because if China, is willing to cooperate on fentanyl, but eventually it will be still a focus on the trade relationship. So it would be hard to see that the U.S. wouldn't put any extra tariff on China. So we still think there's something going to be there. But it's not going to be the 60% threatened because that would be just too much a shock even for the U.S.
How is the PBOC going to balance here defending the yuan versus providing sufficient monetary policy support?
Yeah, I think, what has happened this week is a little bit good news for the PBOC, as in, yes, we have the 10%. Okay, I understand, the market may expect this to go away. That's why the yuan hasn't really responded much. But it does show, maybe it's not too difficult for the PBOC to manage the currency. What we need to see, of course. In the extreme case, if the U.S. really willing to go very far on tariff, of course, that would be much more challenging. But if it's 10 to 20%, maybe it's quite okay. Then given this, I think the PBOC may still have the scope to cut interest rates, but the more important thing is actually the fiscal side. Right? I think the PBOC pretty much has done a lot of the job, but we are still waiting for March 5th to see how big the fiscal budget will be this year. And I do think Beijing will deliver to a certain extent.
We do want to ask you about the fiscal policy.
Yeah.
Just one more on the monetary policy.
Sure.
Do you think that the PBOC monetary policy is being hijacked by U.S. tariffs, or is it at risk of being hijacked by U.S. tariffs?
Yeah, it's possible. I mean, if we have very serious tariff, it would be very difficult for the PBOC to ease. That's a reality. But given dollar is so strong already, right? You look at the pattern in the rest of the region. More and more central banks just like, okay, we're going to ease, we will ease. I think the PBOC will have some scope this year.
Now, I guess on the fiscal front, I mean, let me borrow also the analogy that Rebecca just used, being hijacked by things that are beyond the control of China. Typically they come out with a budget deficit target and that's it. Do you think there might be scope actually to come out with a higher number just in case of the different scenarios we don't know at the moment?
I think it's quite possible. Actually, our view is that, yes, the deficit will be bigger first. It could be close to 4% or even higher, but let's see. And equally importantly, what's going to be the quota for the special CGB, right? Last year, already, this started to become a new tool in terms of topping up on the fiscal punch.
Right.
This year, I think it will be even more, that's going to be announced. So we're looking for 2 trillion RMB special CGB to be announced this year. So that's 1 trillion additional. Then the special LGB is another component. But putting everything together, including, last November, they announced, how they're going to help the local government to ease their debt burden. This year, the fiscal budget is going to be more meaningful, more material, because the local governments can worry less about deleveraging. So that would make actually a lot of difference.
I want to pick up there and ask about the deflation story. I mean, how worried are you about deflation? And is your base case for that additional fiscal stimulus, is that enough to start combating and changing the narrative here?
Yeah, actually, we do think so. We do expect China's inflation to gradually pick up. We do think actually nominal growth will be better this year, despite the tariff. I think, right now we're focusing on, the unpleasant side of the tariff. But to me, there is a silver lining here, which is you finally push the Chinese government to do the right thing, which is to support the domestic demand. Because when you face it, there is no other country in the world can absorb China's supply other than China itself.
Well, that takes us to potential green shoots, right? So supporting the consumer. Are you seeing any green shoots, whether that's in first-tier cities, for example, on the property side, or any high-frequency data that we managed to get a glimpse of from the Lunar New Year holidays?
Right. So the New Year spending is okay to decent. And it seems that the housing sales momentum, the positive momentum in the top-tier city has sustained. So that's definitely going to be very good for the consumption if it could continue this way. I think there are small things compared to the macro, but actually, DeepSeek, right? That news. Okay, yeah. It might sound like something unrelated, but I wonder if it's actually also quite positive to the confidence onshore. And you can see, stock market somewhat responding in that way.
That's right.
Yeah. So I think this is all going to play out, putting everything together. Then with a bit more fiscal. Yes, China can do better this year.
quickly here, just to end, thinking about the rest of the Asia-Pacific, clearly during the first trade war, many Asian countries were beneficiaries.
Right.
That looks very different this time, not least sort of countries like Vietnam, where high trade deficits are really putting them in target. What are you expecting? And to what extent, actually, can we really game this out? I know a big part of what your note is and what many economists have talked about is the uncertainty element.
Right.
Here.
This is actually, to me, a more important question, tariff question this time around. Actually, not just the narrow scope on what's going to happen to China. The more important question is what's going to happen to Southeast Asia economy. As you mentioned, Vietnam is really top there in terms of their reliance on the U.S. demand, their reliance on China's supply, right? So to this, it goes down to this question that increasingly people looking at is what does the U.S. government really want? Or what does the Trump administration really want? Do they really want to narrow the deficit? Then they need to levy tariff on everybody, essentially. Or do they want to push for further decoupling with China? Then they need to focus on the countries that rely on China. So whichever goal between these two they're going to take, it seems that the rest of Asia will get some tariff too.
Yeah, those are important questions.
Yes.
You can't have your cake and eat it too at some point. Right. There we go. Wei-ya, thank you so much. Happy Friday. Have a good weekend ahead. Head of Research, Chief Economist for the Asia Pacific at SocGen. Right, going into the open today, not as bad actually as futures had suggested. Still some downside across your screens, although we are still on track, broadly speaking, to end the week higher for a fourth straight week as far as Hong Kong goes. Plenty more ahead. This is Bloomberg.
Yeah, a few handful of names here that we are watching for movement today. We'll kick off with China Renaissance. That's really off the back of a Tyson report citing sources saying that Baofan could be facing potential prosecution for bribery. Of course, a very high-profile banker in mainland China. Young China also in focus, up 4.45%, sort of catching up with some of the gains we saw in the US for that name overnight off this very strong, robust earnings beat coming in, particularly on expected comparable sales and margin restaurants. Again, Li Auto had an upgrade there for Macquarie, Dave?
Yeah, on the Hong Kong listing to outperform, ADR is also getting a bump up, and SMIC's done exceptionally well, which put everything together is really a market that's done well. Momentum's behind this market. The Hang Seng Tech Index is on the verge of a bull market that's 20% from a low. And turnover, as you can see on your screens, has come back in a big way in mainland China. First time in several weeks, we've seen $1.5 trillion in traded value. The open is next. This is Bloomberg.
Welcome back. You're watching The China Show. Good morning and happy Friday. We are counting down to the open of markets, Dave. And it was we've had a bit of whiplash this week, but it does look now, particularly in Hong Kong at least, we're turning a little bit more to the upside. Yeah, the market's got a scare going into, I think you have to look further back, U.S. elections, and then you had the downdraft going into Christmas and the New Year. And then this recent momentum we've seen over the last, 4 weeks or so has actually now taken the one specific benchmark to tell you about. The Hang Seng Tech Index is now on the verge of a bull market, so very, very close to that as well. There's an AI robotics team that has really emerged as something of an offset to some of the weakness out there. Just in case you're just learning about the SMIC rally, and in case you missed that, sorry. A lot of people missed it, though. I mean, the stock has effectively, tripled, I think, since the low of last year. So going into the open today, flip the boards, please. We are looking at some weakness. Although I think when you look underneath the hood on the CSI 300 itself, turnover, as we were pointing out, topping 1.5 trillion RMB on Thursday, which was effectively the highest going back, I think, to about early December, if not mid-November. That being said, of course, the market has been shut, so maybe there is a lot of sort of pent-up buying taking place. Bond auctions today, as we told you about, 1- and 30-year bonds on deck today. The story across the Hong Kong markets, flip the boards, please, if we can. The level to watch is 50.5066 on the Hang Seng Tech Index. In fact, right now, we are at these levels, at about flirting with that exact level right now, should put us very much on track, assuming the market closes right now
to enter a bull market by the close today. We are getting a weakness coming through across Hong Kong markets, across some of the big tech names, bottom of your screens. Change the page, please. So we have a couple of things that we were tracking earlier on. Rebecca was telling you about this. So China Renaissance, two stories here, right? One is based on some of reports out of Caixin concerning Baofan the bribery charges might be on deck. That's number one. Number two is we do understand that there are some potential buyers here for the business also out of Caixin there. Young China is an earnings story. Sales beating estimates. They also boosted a dividend by 50%. So that's going to happen with the stock. I think it was up as much as 10% overnight. Li Auto is an upgrade story from Macquarie. And SMIC, we just talked about that, so I don't need to spend a lot of time on that. Very, very quickly, robotic stocks or robotics-tied stocks did very, very well this week, pairing some of the gains. Limit up in some cases yesterday. And speaking of momentum, the Hong Kong benchmarks. Let's look at that, please, if we can. With the Hang Seng Tech Index now up 20% from the January 13 low. So momentum has returned to Hong Kong markets. 3 benchmarks and the 14-day RSI for all three at about the 70 level,
yes.
which is a good line in the sand in this case.
Well, we've got someone perfect to discuss all of this and more. Let's bring in Wendy Liu, Chief China Equity Strategist at JPMorgan. Just want to pick off and stay on that theme of tech that Dave was just talking about. Let's talk about AI first. How much of this is truly a fundamental sort of offset to some of the tariff weakness that we're seeing? I'm thinking not just of necessarily of AI, but all of the sort of AI-adjacent industries and sectors.
Yeah, and some of the AI adjacent sectors are also more in scope for potential sanctions. And I think at this point, people are just quite excited about the development that there are more companies and sectors that could be invested beyond computing. And you're seeing these innovations and vertical applications in humanoid robots. And according to analysts, this will help biotech in terms of diagnosis and drug discovery. So I think you're going to see a broader range of companies in the edge area, semiconductor, electronics, and then also device. I think this is sort of cheap valuation vis-a-vis, what's available elsewhere, and then a new source of growth.
Yeah, do we know enough about the AI story to figure out which specific sectors or group of names might benefit? Because people seem to be buying first and asking questions later.
Yeah, I think it was computing, and the computing sort of ecosystem, like cooling, optical components, because the initial drive is really about building infra. And I think building infra that continues because you have apps coming here, making it easier for people to use. The like of better LLMs are really the data infrastructure that enable broader adoption. And so on top of that, you'll have retail, you have enterprises, increasing usage. So that's good for cloud, that's good for software application, that's good for edge. Replacement cycles are probably going to get better, and you'll have more part of the network, the Internet of Things, network of things, having to deploy more semiconductors, and then vertical category killers. So just like the Internet, broadband, over time that move into mobile internet, there's just a lot more companies for us to invest in.
Yeah.
Wendy, there's maybe an argument to be made, partly from what we've seen this week with the uneven trading and sort of whiplash around, for example, the USPS suspension, the ban, will they, won't they? Some of the AI news that is still coming through, offsetting the tariffs. Are they going to come? Are they not? The back and forth on Canada. I want to ask about whether or not it's still possible to sort of trade indices. Do you actually have to be a stock picker to do well in 2025?
I would agree. I think thematic will outperform because there's so much noise. When the U.S. election result came out, I think the market had an escalation phase with regard to trade tensions. That ended on January 13th, and people had a relief rally. Now I think the market is trying to assess, is this a re-escalation, which a lot of people think it is? Is this a standoff? Standoff would mean consolidation. Re-escalation is going to be a correction. But then the safer ground appears to be AI, where there is structural growth.
And even within thematics, do you have to shift your strategy? I'm thinking about, for example, the alumina was added to the entities. That took some by surprise. It wasn't like PVF, which had been already flagged as being investigated. There are names that are being caught up somewhat unexpectedly, even when the sectors or the themes themselves are doing quite well.
I can't comment on single stocks, but I go back to your earlier point. It requires a little bit more fundamental study into the single stocks to understand where the risks are. And I think to the degree that a lot of the stocks have been oversold, we do see some interest coming back to the investors, and they say it's priced in already. But then we also see caution because, 2.0, we learned from 1.0 that there could be a lot of surprises. And then China is different from Mexico and Canada. The deal will be more complex, so it's going to take more time. So we do think this, uneven phase will last at least into March, where we get a little bit more visibility from the MPC. Yeah. Yeah,
and I guess to your point, the fundamental question, the intersection between tariffs and thematics is really what the earnings exposure is. So what scenarios have you guys gamed out? So for every unit of growth that gets taken away because of the tariff uncertainty, what happens? What are the benchmarks that are most exposed from an earnings perspective, for example?
We did some sensitivity study. So, 1.5% of the GDP get hit due to tariffs, that we're going to see about low single-digit impact on MSCI China and CSI 300 earnings in 2025. It's not a high number. It's, 1 to 2%, because these two indices on a first order of impact basis don't have a huge exposure to export. MSCI China is about 4% overseas revenue, CSI 300, 14, general economy, 19. But small mid-caps, they have higher exposure, 15, 16, 18%, depending on the index. So they would be hit a little bit harder. But in these kind of markets, it's thematics among small mid-caps.
Okay.
Surprisingly, yeah.
You just mentioned March meetings, of course, MBC. It's going to be a very important moment for investors. What do you think? I mean, assuming that Beijing delivers enough support to offset whatever the cost is of tariffs, which so far are relatively low, what is it that investors need to see in order to see sustained momentum, particularly when it comes to both the onshore, I guess onshore and offshore China stocks?
Right. And I think to finish out David's earlier question, in these markets, it's the multiple. It's less about the earnings. In the re-escalation phase, multiples will compress more than the earnings impact. Okay. And coming back to your question, Rebecca, I think people do want to have a sense on where the trade tension will end up being, because that is the biggest overhang. The preference is to see more consumption stimulus, which we see in small pieces, but not in a big one. And then what will help on the single stock basis is earnings coming through, like you described just now. So consensus earnings on MSCI China for 2024 was originally 14 and change. Now it's 16 and change. So if it could actually hit that number, I think there will be more confidence in terms of the single stock investability. Yeah. And we'll know by end of March, early April.
Right. It's also worth pointing out we've rarely hit that number from the start of the year, that consensus growth number, by the time we get to the end of the year. But so tell me this then. Where are we seeing where are we likely to see the biggest earnings revisions higher from this point in time? In which sectors?
There are two sectors that have been very depressed. If we look at how much the subsectors have fallen since their peak in 2020, 2021, there are two sectors, property and healthcare. We put them on neutral at this point in time. The best performing sector has been energy.
Yeah.
So I think we had a 3-year down cycle in terms of earnings for China from 21 to 23, and 23 eventually turned, and 24 is picking up on the macro data, since September, we're seeing growth momentum improving, not exactly to the growth stage, but in the recovery stage. And generally, there's a spring spurt. So we're kind of waiting to see if this is the same this year. I would think growth and cyclicals is where the earnings are going to be coming through a little bit more. So we started to overweight industrial and materials, and we've been overweight IT. And utilities and energy are neutral. So I think the barbell strategy is the way to go during these choppy times. Yeah. And thematic will help.
What about the other side that's become, well, at least that's rewarded investors, which is the dividend or the income strategies? What happens to that trade?
I think...
Or the SLE trade. Let's call it the SLE trade.
If we look at the best performing sectors since 21, they've been the value income sectors, utility, energy, financial, utilities, and these are big dividend payers. And they have ready buyers from the lifers and the income funds. And the lifers tend to put more money into these stocks in Q1. So I think from a seasonality perspective, that is pretty favorable, and particularly for the offshore, the yield's also higher than onshore. So I think for the different investors, there are different buyers, and therefore part of the barbell continues to be the dividend-paying, quality value.
Okay. Wendy, thank you so much. It's nice to see you. Have a great rest of your year ahead. Wendy Liu there, Chief China Equity Strategist at JPMorgan. So if I remember correctly, that's industrials, materials, some of the IT plays that are sort of leading that sort of sector. Listen, speaking of IT, yep, we are on track to enter a bull market. On the Hang Seng Tech Index, we're still above that threshold right now. Coming up here on shows, Chinese retailers on Shein and Temu are feeling the impact of tariffs already. We get you the details on that story just ahead. Happy Friday. This is The China Show.
Time now for a look at what's trending in China. That's a look at what is making the headlines in national newspapers. Now, after USPS walked back on an earlier decision to halt some shipments from China and Hong Kong, an editorial in the Global Times says the U-turn not only reveals contradictions from Washington, but also highlights the resilience of US-China trade relations.
Now, the piece points out small parcels can contain daily necessities for, well, American households and businesses, and say that they are actually the ones bearing the brunt of these tariff policies, and that's something officials are actually echoing.
The United States recently imposed a 10% tariff on Chinese products exported to the United States and adjusted the tax-free policy on small value parcels. This will undoubtedly increase the consumption costs of American consumers and undermine the shopping experience.
Yeah, and that was the Chinese Ministry of Commerce just there reacting to the tariffs in China. Now, retailers on Shein and Temu are actually already feeling the pinch here. Logistics agents have asked them to pay an additional 30% levy on goods heading to the U.S. from China and Hong Kong. For more on this, let's bring in Min Min Lo, our China correspondent, to talk us through what exactly we're seeing. And yeah, they're getting squeezed already.
Yeah, and actually these retail platforms, they are being asked by their logistics agents to pay that additional levy as a deposit, which then they have to top up or have their deposit returned, depending on the actual charges from the U.S.
Let me just, I think we just have some issues there with Min Min's mic. Well, she's not bluffing. She is in fact talking. So we're going to get that sorted right now. And as we, let's head to the break first as we sort out these tech gremlins right now. Leave you with a look at these markets, and we are on track still to enter a bull market here in Hong Kong. A beautiful morning this Friday. This is Bloomberg.
Here are some of the top corporate stories that we are following today. Now, Tyson is reporting that Bao Fan, the ex-chairman of China Renaissance, may face prosecution for suspected bribery. The outlet quotes sources saying the investigation links to a former executive at ICBC who was paid a sign-on bonus of $2.9 million when he was hired by Bao. Bao Fan was taken away by authorities 2 years ago, and Tyson also says China Renaissance is currently seeing interest from potential buyers. Republican attorney generals from more than a dozen U.S. states are looking at the Chinese investments of large asset managers. So the institutions include BlackRock, JPMorgan, Goldman Sachs, and Morgan Stanley. In a letter, state officials spell out the risks of tariff and investment restrictions on China, as well as the potential invasion of Taiwan. And Puma says it plans to ship fewer Chinese-made sneakers to the U.S. It's relying instead on suppliers in Vietnam and Indonesia as the trade war with China heats up. The German company says it's now sourcing only about 10% of its U.S. shoe imports from China, down from 30%. And Chinese retailers on Shein and Temu are already feeling the pain of tariffs.
Okay, actually, here we go.
Yeah, here we go.
Oh, wait, who's on camera? Min Lo is on camera to tell us about this story that these retailers on these platforms are being asked about how much deposit?
30%.
Okay, for what?
So they're being asked by the logistics agent to pay 30% deposit, which they will have to top up or have it returned to them depending on the actual tax charges from the U.S. Customs. And this is after the U.S. Postal Service had flip-flopped on their policy about whether to accept parcels from China and Hong Kong. They have reversed that now, saying that they will find a more efficient way to collect those tariffs. But then you have the Hong Kong Post now saying that they are not accepting parcels that are being sent to the U.S. because they are in talks with the U.S. Postal Service. They're still clarifying certain issues. So either way, there is going to be some disruption to the post. The question is how long, and that is what retailers are most worried about, especially small businesses that are working very hard to protect their reputation with consumers, and also the factories. They could be at risk of closure if there is any halt to these deliveries because they're already operating on very razor-thin margins. They don't have a lot of room to lower prices further, which means that U.S. consumers will likely have to bear the brunt of any price increases. And especially this is going to be acute for those low-value goods like socks, fashion accessories that are being sold. And Nomura, for example, is estimating that China had sent about $46 billion worth of these goods, small parcels, each valued at less than $800 last year. And of course, these parcels used to be exempted from any customs duty because of the de minimis rule, but now that is being revoked by Trump. And Nomura is saying it could cost China about 1.3% of its exports growth and about 0.2% of its GDP. So pretty significant, given that China sends about, that these small parcels make up about 11% of China's exports to the U.S.
And you mentioned the Hong Kong Postal Service is there as well, but it's not the only way that Hong Kong is really being caught in the crosshairs between US, China here. The anxiety that a lot of businesses here have always felt, which is that Hong Kong increasingly appears to be getting lumped in with China when it comes to policy making. Just tell us how, that's sort of risking Hong Kong's status as a financial hub.
Yeah, and I'm sure you know very much about that because you co-wrote that story as well. And
pretending to ask the question, Rebecca.
Please tell me about the story that I wrote earlier today.
Yes, so President Trump, if you recall, in his first term in office back in 2020, he signed that executive order to end preferential treatment for Hong Kong when it comes to economic and trade matters. So what this means is that those 10% tariffs imposed on Chinese goods, for the first time, they also apply to Hong Kong goods as well. But for now, economists are saying don't panic because the tariffs apply to goods manufactured in the city, and that applies to about just 1.3% of Hong Kong's exports to the U.S. Things like jewelry, metals, gold, because the bulk of Hong Kong's exports consist of these re-exports from other countries. So that's the good thing. But there is a psychological impact here because you look at companies like Hutchinson's, which operates that 2 of the 5 ports in the Panama Canal that is now being targeted by the U.S. Companies looking at that case are going to think twice about investing overseas, especially in strategic sectors that could potentially
actually come under fire from the U.S. administration as well. So all of these adding together, you mentioned the postal service disruption, they really threaten to ruin Hong Kong's reputation as that stable business hub, that international connector between mainland China and the rest of the world, especially when these policy differences between mainland China and Hong Kong starts to erode over time.
Yeah, Min, thank you so much. Min, Laura China correspondent there. Yeah, Rebecca, we're talking, when we covered some of these conferences, and it was a very busy conference month in January, the notion that Hong Kong might need to do more just to give out the message that while it is one country, two systems, it is an international hub that they also want to put forward there. They might need to delineate a little bit further there in terms of the policy messaging.
Look, it's interesting. So I spoke to Regina Ip. She was at Davos, actually, and we talked precisely about this. She says that Hong Kong needs to do more, it ought to do more to differentiate itself from mainland China. And her point also is that actually this is something that President Xi has stressed previously during his speeches visiting Hong Kong, visiting Macau. It's these differences that really attract foreign investors. But I don't know whether there is an argument to be made that Hong Kong perhaps hasn't done a good enough job about promoting the differences.
Yeah, when you do get, I wouldn't say confusion, but it's almost a deliberate policies and, for certain companies, for example, that just maybe loop Hong Kong into that same basket as Min was pointing out. So yeah, it's an ongoing conversation. Of course, you can check out, by the way, Rebecca's story. It's on the terminal right now as well for everyone, and certainly underscores the very point, this Hong Kong as an international finance center and sort of the stresses given the states of geopolitics out there. Plenty more ahead. You're watching The China Show. Good morning and happy Friday. Welcome back to the show. We're just entering the second hour of the China Show, 30 minutes into cash market session, and we're on the up as far as price goes. We're also on the up as far as turnover and volumes, and who would have thought, just almost barely 5-6 weeks into 2025 and we'd be talking about a bull market. And that is in fact where we are right now as far as Hang Seng Tech Index goes, 5,100 on the HS Tech Index, which gives us enough about 30-point buffer for that bull market level that we're tracking here at about 30, 50, 77 thereabouts here. But yeah, it's been a good 4 weeks or so. The gains today are really led by, I think, this group of stocks coming up on your screens right now. So EV stocks, right? So the Xiaomis of the world, XPeng. The latest news here is Li Auto getting an upgrade out of the folks at Macquarie here. So both the 8 shares to outperform and the ADR is also getting an upgrade. Xiaomi, of course, coming through as well with this announcement and the dates for the release really of both the handphone and also the car. Asia ex-China is looking like this. So we are looking at mostly declines. And I think which underscores really that this Chinese market has really divorced itself of late from the broader gyrations, broadly speaking as well, and certainly the AI robotics tech theme has really given this market new life. The story across S&P futures right now is one that is flat, not on your screens. Our European futures, I can tell you about that, also seeing some declines after just massive session over in Europe yesterday. The 2- and 10-year yield, we'll talk more about Scott Bessent's comments. We spoke to him a couple of hours back that they will let the Fed do what they do as far as monetary policy is concerned. They will focus on the Treasury side and the government, what they can do as far as government measures to lower market interest rates like the 10-year yield, for example. In fact, just on that very note, as you look at the Treasury curve right now, ahead of the jobs report later today, we did hear from Scott Bessent talking about the Fed. Have a look.
One of the things I wanted to emphasize is that we are not focused on whether the Fed is going to cut, not cut. What we are focused on is lowering rates. So we are less focused on the specific of rate cuts and how do we get the whole curve down. I mentioned that the 10-year, I believe, is the important price to focus on. It's mortgages, it's long-term capital formation. So, and look, I think with the president's policies of energy dominance, deregulation, and non-inflationary growth, I think that the 10-year is going to naturally come down.
Mark Cranfield joins us right now, our MLive strategist. Mark, we were talking about this yesterday, following, of course, the Secretary's interview with Fox. And now that we at least know specifically what they want to do and market interest rates as it affects consumer finance, for example, how do markets approach this right now?
So far, the bond investors in particular are fairly relieved what they've heard from Mr. Bessent. He doesn't want to tamper too much with the quarterly funding, which is good news, particularly in terms of issuing long-term debt. He seems to be keeping it on pretty much the same level as it was before. So that's reassuring. He also still believes in a strong US dollar, which again is great. International investors will be happy to hear that as well. What he hasn't addressed is the trade deficit or the fiscal deficit. Now, they will be, over the medium term, they will be major concerns to people that want to invest in US Treasuries. It will need a bit more time to see how new policies from the White House play out in that respect. But certainly, everything he's been saying so far is not having a major impact on the market, a bit more curve flattening than anything. So from here, traders will be looking more at the data coming up. Non-farm payrolls today, of course, is a big one. More importantly, you've got the CPI report next week. Maybe it gives us the first indication of whether there's any inflation changes since Donald Trump came in the White House. Maybe a bit too early to tell, though. But so far, Mr. Bessent is choosing his words very carefully, and that's pretty reassuring to investors.
Mark, I want to ask you something actually. Viewers were sort of chatting with me about, and I want to put it to someone much more qualified than I am. The long end of US Treasury still seems relatively high. Do you think that is pricing in risks for the Asia Pacific, particularly, I guess, thinking about trade wars, tariffs?
I think where the long end of the Treasury curve, it's really more a domestic focus. So investors want to see whether or not US inflation can get well below 2%, or is it going to get sticky around there? They need to have some sort of cushion to justify yields going much lower on inflation before they can do that. Then, of course, you have to take into account the US is still running very big deficits. Until they get their current account deficit tighter, it's going to be hard to justify US yields, for example, coming down to the level of some European yields. European yields are way lower than they are. Now, that partly reflects the changes in the economy. US economy is much stronger in general than what's happening in Europe. But it also shows that investors fear that the US isn't getting it under control. The rating agencies at some stage may say that this is an unsustainable situation for the United States. They may need to downgrade them. It's not something that's going to happen immediately, but it's been on the radar for a while, and there's been no sign of improvement. What Mr. Bessent is saying doesn't address it yet, but clearly global investors will be watching very carefully to see if America retains a strong economy and a wide current account deficit, then ultimately that is not going to be good for the rating of the US bonds.
Mark, yeah, that's a good point. So Scott Bessent told us to, if we want to find out what the Fed wants to do, ask the Fed. So I look at the Fed, and Lori Logan says, hey, to Rebecca's question on the long end, why that remains high, it's probably because the economy is doing well and that the Fed might not need to even cut interest rates. Is that still a tail risk for markets, that the Fed doesn't move, or is it something to consider right now?
I think there's already some people suggesting that is a possibility. Miss Logan is hawkish by nature, so you can slightly pass her words there. She would normally come out in that direction. But clearly, there are more people from the Fed suggesting that we need a longer pause, and they want more time to assess how potential trade friction will work out, in how it will affect the US economy, how will it reflect the outlook for growth and inflation. Put all those things together, and a central bank in general will prefer to do nothing while it assesses data. It will not rush to do one thing or the other. So certainly the way things are playing out, it is giving the Fed more reason to sit on its hands, absorb the incoming data, see if there's any changes in White House policy, see how the reaction comes from other countries overseas. In the meantime, they're probably quite happy with the situation. They've already lowered interest rates by a reasonable amount. They have a slight cushion over the current CPI level, but they're quite unsure where the data is going to go over the next few months. That's a very good reason for just sitting on your hands.
Mark, quick thoughts on China. Why is this market doing so well?
tech. What these and the good thing here is that people are beginning to understand. If you look at the performance of the HCI Tech Index, compare it to the CSI 300, for example, over the past few months, the Hang Seng Tech Index is almost back to where it was in October, and the CSI 300 is nowhere near it. And if you look at the underlying stories, it's all about specific things related to AI, related to other parts of the tech universe. And people are beginning to believe that China can isolate itself to an extent and promote its own tech companies. They can make good profits with the domestic economy, regardless of whether they can filter into the rest of the world or not. And that's beginning to get some traction, and people seem to like that story.
Bloomberg's MLive strategist Mark Cranfield there. Meanwhile, the US Treasury Secretary also defended President Trump's new tariffs on China, saying they're only designed to ensure fair trade. Bessent dismissed concerns the levies will be inflationary for the US, telling Bloomberg that China will pay the higher price.
China is the most unbalanced economy in the history of the world, and they are in a deep recession right now. They're experiencing deflation, and they're trying to export their way out of that. And we can't allow that. We want fair trade, and part of that is taking a strong position on the currency and the terms of trade.
But what about the inflation concerns that are stemming from the tariffs and tariff threats?
Look, I'm not sure that where this narrative that tariffs for the country putting on the tariffs is inflationary, that we could have a small one-time price adjustment, that as we saw in Trump 1.0, that the deregulation and the other policies, we stayed right around the Fed's target level. So I'm unconcerned about that. I think especially that China now, given all their excess capacity, will, no matter the level of the tariffs, will end up eating quite a bit.
There's a lot of uncertainty around tariffs. We see them threatened or signaled, and then they're taken back. It appears as if this administration might be unfriendly to businesses. Is that right?
I think it's just the opposite. I think this is the most pro-business administration in history. And everything we are doing is going to increase the after-tax return on capital. And as a result, working Americans will have very high real wage growth. That what we've seen over the past 4 years is the government and government-adjacent sectors providing the employment growth. And why have we experienced this affordability crisis? First, there was a massive spending met by increased regulation, which caused inflation. And then government and government-adjacent jobs do not cause real wage growth because they move up at CPI. So, I think that we are going to not only be business friendly, but very, very friendly for working Americans.
US Treasury Secretary Scott Bessent there speaking to Bloomberg's Saleh Mohsin. Still ahead on the China show, we speak to the CEO of Hong Kong e-commerce firm YesAsia about how they're riding the K-beauty wave while managing the trade war and a slowdown in China. Japanese Prime Minister Shigeru Ishiba will meet President Trump on Friday in Washington. As he left Tokyo, Ishiba told reporters he wants to build a relationship of trust and confirm cooperation over economic and security issues. Bloomberg opinion columnist Garode Reddy says the Japanese leader will be playing for a tie during the talks. He joins us now from Tokyo. I mean, do you think the expectations are too high for Japanese-US ties, in part because, of course, of the relationship that Trump had with former President Abe?
Yeah, certainly. I mean, I'm not sure if the expectations, at least on this side of the equation, are particularly high. I think everyone here mostly sees that this trip largely involves downside risk, the idea that something's going to go wrong, that Trump is going to pull out some tariffs on Japan that nobody is expecting. And there isn't really that much upside. Japan doesn't really want anything other than the status quo. There's nothing that Ishiba is going to try and get out of this arrangement. There is going to be a lot of talk, apparently, according to reports in the joint statement that they're going to issue, about forging a new golden age for Japan-US ties. But I think that's largely just talk.
Garo, David here. Lots to unpack here because, we saw what happened with Canada and Mexico, right, as far as the U.S. allies are concerned. And Japan is arguably the biggest one in Asia. But before we get to that, can I just ask you, too, about where are interests aligned for both parties, just so we can look at our potential wins here?
Well, certainly it depends, obviously, on any day of the week what the Trump administration actually wants. If the Trump administration does want to, crack down on China and exert influence and control over China, Japan is an absolutely crucial partner that is required in order to, for example, we saw how the Biden administration tied up with Japan in order to increase its exports of semiconductor materials, its export controls of semiconductor materials. So that's obviously going to be one. From the Japanese side, Japan is looking at the security situation, obviously, in Asia. They're going to be looking to, one of the big things the Japanese side, I think, want to get out of this is confirmation once again that the U.S. obligation to defend Japan in the case of an attack also applies to the Senkaku Islands, which China also claims for its own. So I think both sides they're not really going to be looking to get much out of it. In fact, when Trump was asked about this meeting last week by reporters, he really struggled to come up with anything that he wanted to get out of the Japan side. So, and you saw in the election campaign, he spoke about Canada, he spoke about Mexico, he spoke about China, but to the best of my knowledge, he almost never mentioned Japan at all. And I think that goes back just to the earlier point. That does go back to Trump's affinity for and friendship with Shinzo Abe.
So if he's playing for a tie here, and hopefully this goes to borrow a basketball analogy, this goes into overtime, what are the downside risks that he needs to be paying attention to?
Well, obviously we've seen, so many occasions, even in the last week alone, where you think the Trump administration is going to do one thing and something just comes completely out of left field. So, I don't think anyone was expecting, for example, Trump's comments on Gaza that came out, just earlier this week. So I think Japan will be very careful to try and play it safe and to try and make sure that there aren't any surprises. Now, obviously, there's a. In terms of an investment partner, Japan is, the largest investor in the U.S. and has been for 5 years running. But the U.S. also has a substantial trade deficit with Japan. I think it's the fifth largest. It's nowhere near as large as it is with China or with other countries, but it is substantial. We saw in the first Trump administration that Trump was prepared to put pressure and to put tariffs. There was tariffs applied to steel that included Japanese steel at one point in the first Trump administration. Something like that could absolutely come out of the Trump administration, even though I think at this point in time we don't expect it to.
Garo, thank you so much, Garo Rhee there, our Bloomberg opinion columnist over in Tokyo. Coming up here, the Bank of Korea Governor Lee Chang-yong tells us exclusively where he's seeing the biggest impacts of the Trump tariffs outside of China. That conversation is just ahead.
The Bank of Korea governor thinks while the Trump tariffs will affect the country's economy, it's still better positioned compared with other U.S. trading partners. Speaking exclusively to Bloomberg, Lee Chang-yong told us how he sees the trade tensions playing out.
Definitely, I would say this is negative news. The U.S. tariff policy will definitely have a negative impact on Korean economy, as I mentioned. Since Korean economy heavily depends on export sector, And we will have a definitely direct as well as indirect impact from U.S. policy. Direct, what I mean is that our export exposure to the United States is around between 6 to 9% of our GDP, depending on the year, which is significant. At the same time, our connection to Mexico, Canada, through global supply chain is quite significant too. So tariff on Korea directly, yes, at this moment, Japan and Korea is a little bit off the radar at this moment, but that can change any moment. So direct tariff on Korea can have a negative impact, as well as the tariff on other countries, which are our major trading partners, will have an indirect impact. But having said that, I think I want to mention also positive note. Yes, impact will be negative, but compared with other major trade partner of the United States, we are better positioned and we are vaccinated earlier. What I mean is that, after the shutdown of our trade with China, after our deployment of THAAD missiles, as you know, a couple of years ago, and also the U.S. strong restriction of tech transport to China, especially semiconductor, in last couple of years, actually make us, our businessmen, to expedite the deployment of their production base from China, outside of China to other areas. So China Plus One policy has started quite earlier, and then after that we proactively diversified our production base across the world.
Are we less exposed to the slowdown in China then?
Compared with a couple of years ago, for example, China was number one, our trade partner, if you look at 5-6 years ago. But now U.S. and China is neck to neck in terms of our exposure. So, and then also another factor is that we have, if you look at our traditional sector, definitely we are exposed on tariff, and China dependency is very high. On the other hand, we have many industries that can have a strategic cooperation with the United States. For example, shipbuilding industry is one thing. The other one is semiconductor, especially AI sectors. We have a lot of room for the close strategic cooperation with the United States. So in that sense, I think we are a little bit better positioned to having a kind of give and take negotiation with the United States.
Semiconductor exports drive a huge part of the South Korean economy. We're seeing now the potential of cheaper, more cost-efficient AI models from the likes of DeepSeek, for example. If that depresses prices, demand, is that going to be an immediate concern for the broader economy?
We are currently looking at and analyzing what DeepSeek means for Korean semiconductor industry. So it's a little bit premature. I probably need a little more study. But in general, as for the semiconductor industries, I think there is some kind of heterogeneity in the two different impact. One is if you focus on the legacy semiconductor, which is like a low-end products, I think we already have lost the price competitiveness to China, even for a couple of years ago. So that business is no longer will be our businesses. On the other hand, for the high-end products such as HBM and the AI products, Korea's two, Samsung and Hynix, are the leading producer. So depending on the prospect of AI industry, we can have an opportunity. And on the other hand, as you mentioned, if the DeepSeek and other AI development will it will make the demand for these high-end products not as great as expected. Still, I think there is the other impact. DeepSeek's availability of DeepSeek and other AI technology means that there will be a more high-tech, low-price, cheap demand. Because this AI technology can be used for the semiconductor mobile product. So far, most of AI semiconductor focus on the semiconductor for the server, very high expensive one. But if you can produce a little more cheaper, semiconductor for more wider use, I think who can produce it? It's Korea. So I think in that sense, I think I'm very optimistic, and I think the AI industry is definitely Korea is better positioned than any other country.
And that was the Bank of Korea Governor Lee Chang-yong speaking with, of course, Sherry there over in Tokyo. The reason I'm looking to my left is I'm looking at this market in Hong Kong about an hour into the session, and we are on track to enter a bull market. There we go. Hang Seng Tech Index is now up 22% from that low back in January. Plenty more ahead. This is Bloomberg. Welcome back. You're watching The China Show. We are just under a minute away from the lunch break over in Tokyo. And really the story here, and I would say ignore the equity markets for now. Yeah, I know there's earnings coming through. Yes, they're important. But really from a macro perspective, it's really where you are with the Japanese currency. We're actually at session highs right now. Yes, we are. On 150 at 151 and change. If you just tuning in to the Japan story today, there was a point not too long ago, about, I would say 2 hours back, when this one had a 150 handle. In fact, I'm looking at my screens, 150.96. We did touch that, which takes you back to about 2-month lows here on dollar yen. Flip the boards, please. Asia is looking like this, and also a cross-section of the sectors we're tracking. S&P futures are flat. The Bloomberg Dollar Index effectively sideways for a second day, softer for 4 days on aggregate. Asia is flat, and really the lift we're getting is really out of Hong Kong. But as you can see on the screens, we're going into the weekend, and a crucial jobs report, I should also mention, of course, out of the U.S., of course, we're on fairly decent footing. Right, just to set the markets aside for now, let's talk about feeling confident and beautiful. You have beauty exports out of South Korea topping $10 billion for the first time last year, even outpacing traditional leader France in some major markets. Our tech reporter, Bell, looks at how e-commerce firms are moving to benefit from this rapid change.
Medicube and Beauty of Joseon. They're not exactly household names for some, but for a younger generation of consumers, these upstart K-beauty brands are becoming the #1 choice. It's symbolic of a bigger trend that's taking place in the global cosmetics industry, where Korea's small and medium-sized companies are getting wider recognition and outselling more established and much bigger rivals. That shift has come about even as K-beauty grapples with a slowdown in sales to China, with firms now targeting new markets further afield. Hong Kong-based e-commerce company YesAsia is one that's riding this K-beauty wave. Through its YesStyle platform, it sells Korean cosmetics into more than 200 territories, with business booming in recent years. Still, there are risks on the horizon, including the uncertainty over TikTok's fate in the US. It's a favourite platform for beauty influencers, including YesStyle's 300,000-plus network. UOB also says the group could face margin erosion as it rapidly expands its B2B unit. But for now, YesAsia says the outlook is bright, signalling record annual profit growth. Annabelle Drewlers, Bloomberg News, Hong Kong.
And Annabelle is with us now, along with Joshua Lau, founder and CEO of YesAsia, joining us exclusively here on The China Show.
Well, Joshua, thanks very much for joining us this morning in studio. And I think what really stands out about the business in particular is that you've been now operating for
25 years.
25 years. And over that time, the business growth has really just exploded in, say, the past 2 years.
3 years?
Yeah,
because
exactly.
of K-beauty, Korean beauty.
And so what exactly is it about K-beauty, though? Because we know that K-beauty has been around for a long time now, but why is it exactly in the last 2 to 3 years something changed for you?
Right. So actually, we have introduced K-beauty, Korean beauty, to many countries in the world since about 10 years ago. And we have seen the popularity actually rising, increasing in the past 2 years, starting with US, and also the popularity spreading to Europe, and lately into many Latin countries as well.
And you have this window into, I guess, really what's happening at the forefront of K-beauty. And it's not necessarily the big name brands that are breaking through here. Just explain to us the sort of makeup of the landscape there.
Well, for the past 10 years, we have developed the relationship with over 400 Korean beauty brands. They are our business partners, and we're very fortunate that we have the authorized distributorship from those brands to many parts in the world. So this authorization is for both B2C online channels as well as the offline B2B channels.
And the focus, though, because we've spoken, of course, before about how the top 5 brands that you're selling in your site are not ones that are more established. It's actually ones that have been around in, say, the last 5 to 7 years. So these smaller and medium-sized names.
That's right.
What are they doing that's different?
So I think compared to the traditional, more established brand, I think the independent brands from Korea nowadays, they're more using the online marketing and strategy first, rather than open up like offline stores or going after country by country. And the online marketing, especially the influence marketing, is actually very powerful and impactful to help the independent brands to reach out to many young and also female consumers in many parts of the world very fast. So I think also YesAsia has been assisting many brands in the influence marketing. I think this is a very powerful strategy.
Why do you think it is that K-beauty, rather than, say, I don't know, Japanese beauty, Chinese cosmetic makers, why is it that K-beauty has been such a winner for your business?
Well, I think for a few things. I think they're early to introduce the Asian beauty products to the rest of the world. And of course, nowadays, the Chinese beauty and also the J-beauties are catching up. And number 2, I think the K-beauties, they're more innovative in terms of their product development, and they're able to develop their product in a very much shorter product cycle. So compared to like J-beauty, it may take like 6 months, 1 year to develop products. We are seeing new products coming from Korea almost on a monthly or even weekly basis. I think consumers find that very exciting.
Yeah, so that speed that they're getting these products to market and that innovation cycle is also making Korean cosmetics companies a very active...
It's an ecosystem that very well established and has been for many years. So I think for new companies, actually it's very helpful for them to develop the beauty products in Korea in this environment.
What about M&A, though? Because that's another area. This is a really hot area that we see in Korea.
Yes, we have been seeing many capital going into the Korean beauty market in terms of like the conglomerates acquiring the independent brands, as well as also the private equity fund also putting investment into growing the K-beauty companies. I think more investment actually is helping to grow the K-beauty in the coming years.
And you've actually also made your first investment into a K-beauty brand.
Yes, recently we made a small investment into a new brand called TTVV. So we're about to launch the brand, and hopefully it can also do well as the other K-beauty brands as well.
I want to shift gears a little bit here and think about how Hong Kong is sort of being caught in the crosshairs between US-China tensions now. I mean, the anxiety for a long time has been that Hong Kong is going to be lumped in with mainland China when it comes to policies. We saw this flip-flop with the US Postal Service suspension, for example. Is that suspension of accepting parcels, of course it's been reversed, is that something that would have affected your business and your supply chains? And how are you adapting your delivery services to try and accommodate for these types of challenges?
Yes, so the recent tariff policy certainly have some impact on our business because we are also shipping packages, quite many of them from Hong Kong to US. So now we are now required to pay tariff. So that means that our cost of doing business is higher. So either we absorb the cost ourselves or we pass on the cost to the US consumer by raising the prices. So moving onwards, actually we have an option because many of the products we are selling, actually 90% are from Korea. So actually we have the option to ship the products from Korea directly to the US so that we are not required to pay the tariff anymore. So in addition, we also have been diversifying our business from US to many other countries. As I mentioned before, actually K-beauty is also getting very popular in Europe. So our website actually offers French, German, Spanish, Dutch, and Italian. So I think those European countries as well as the LATAM also provide a growth opportunity for us to divert our business from just focusing on the US.
Yeah, I mean, I see in your report, the EU overtook your US in revenue growth, I think for the first time, 3-digit growth rate. But you know, the US is still making up a big chunk of your buys. It's still 41%. How, you know, what is the aspiration? How much do you want to bring that down? How high do you want to raise the other? How are we going to redistribute?
I think US will continue to grow. I think more people,
okay.
I think K-beauty is going mainstream in US. Many retailers like Costco, Walmart, TJ Maxx are carrying K-beauty. So I think K-beauty will continue to grow in US. So I think for us, while we continue to do a lot of marketing in US, we also need to diversify into other markets like Europe and also Latin. So recently we also have launched an Arabic language website. So Middle East also present a very good new market for us as well.
You mentioned sort of the couple of options that you have, and one of those, of course, as you said, is just starting to ship directly from Korea, but you don't have the warehouse facilities.
Actually, we have already a warehouse facility in U.S. near Los Angeles for the B2B business. So we already have been shipping product from Korea to U.S. since 2023, May, about 2 years already for the B2B business, because we are also growing our B2B business in U.S. So there's an option how we can convert that warehouse. Also, we can do the fulfillment for the B2C customers in U.S. as well. So we are still evaluating this option.
I guess the question, though, is really what's the business cost and how much does this, say, dent your margins moving forward?
So I think that's the reason why we want to expand the B2B business, so that we can increase the scale of business, so that our purchase volume from our suppliers will be greater, so that we can negotiate a better product cost, and then that will also help our margin as well.
I just want to ask, I mean, this issue of who takes on the cost of a tariff while you're still paying tariffs and you haven't fully managed to kind of get around them. I mean, what percentage are you thinking of? How much are you absorbing? How much are you putting onto your consumers? And how does that, I guess, vary with what you're hearing is the industry standard for your sector?
So the current tariff is 10%, so probably we'll pass like half of them to the U.S. consumer. I think that's reasonable. I think that also helps to reduce our cost of business.
What about TikTok in particular? Because part of the success story for you has been really leveraging that influencer strategy, and you've got a network now, as we just said there, but around 300,000.
Yes.
Yeah, so it's big. But TikTok is one of the favorite platforms. So how are you advising your influencers essentially to navigate what is a very challenging outlook?
So actually, influencer marketing is a spectrum of mega influencers to micro and nano influencers. So TikTok, we're working with mostly the nano and micro influencers. We have about 300 influencers in our program already. So in addition to TikTok, actually many of them also they're creating content for other platforms like Instagram and also Facebook and also YouTube as well. So I think depending on the US situation, we are also working with the influencers, how we can adopt the new environment, the landscape changes.
Okay, and expansion plans. What is your anticipated CapEx spend? Where are you trying to expand? Of course, you have this new investment in a Korean, directly into a Korean beauty brand. Are we going to see more of that?
So actually, we have set up warehouses, not just in Hong Kong. We are about to launch our second robotics warehouse in Hong Kong. But in addition, as I mentioned, we already have an overseas warehouse in Los Angeles. Recently, we also have set up a warehouse in Germany as well as UK to prepare us to further expand the B2B business into Europe and UK as well, because we find that not just online, actually K-beauty for the offline market is much bigger. We think that the offline market for K-beauty is at least 3 times bigger than online. So since our authorization for brands is both for B2C and offline B2B, so I think this is a very good opportunity for this year also. We also how we can expand our service to many B2B customers.
Joshua, thank you so much for joining us. Joshua Lau, founder and CEO of YesAsia, and our tech reporter, Annabelle Jewellers there. And you can get an insider's guide to the money and people shaking up the finance hub in our Hong Kong edition newsletter out every Thursday. You can sign up via bloomberg.com/newsletters. Stay with us. There is plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China Show. So Republican attorneys general for more than a dozen U.S. states are now looking at the Chinese investments of large asset managers for what they describe as a misrepresentation of risks. Now, China government and economics reporter Lucille Liu joins us from Beijing to talk us through this. It's a fairly complex story. Lucille, thank you for joining us right now. So tell us about the companies involved and also what the attorney generals want.
Yeah, absolutely. I mean, you have basically had some of the biggest names in finance. We have, our BlackRock, Goldman Sachs, JPMorgan, Morgan Stanley, all being asked to sort of answer these questions around their investments in China. And so the attorneys general are, basically saying that they haven't made the right disclosures, especially regarding to risks around tariffs, around investment restrictions, and also around a potential military conflict between China and Taiwan. So, to be sure, some of these companies, for example, BlackRock, does make some of these disclosures, especially on some of the companies that it's invested in through indexes and on the potential investment and economic restrictions there. I think all in all, this is just going to be a lot more paperwork for these companies. And of course, the stakes are very high because of the more intense scrutiny they're expected to come under.
Lucy, this isn't the first time that U.S. financial institutions have come under the sort of scrutiny for their investments in China. So what is it that's different about this, and how are the firms likely to respond?
Yeah, absolutely. We've seen the Select Committee target some of these companies before. We had the fund managers at these hearings also answering questions around their investments. But this is the first time for such action under the second Trump presidency. And as we've seen with tariffs, actions can really escalate quickly. So for a lot of these companies, more than ever becomes that question of, is it more trouble than it's worth, their operations and their investments in China? And we had that great reporting around McKinsey yesterday, for example, debating that exact risk reward, especially as the Chinese economy slows and especially as they become under more intense scrutiny.
Bloomberg China government and economics reporter there, Lucille Liu, joining us from Beijing. And here are some of the other big geopolitical stories that we are following today. President Trump has held a meeting with U.S. Steel CEO David Burritt at the White House amid growing questions over the company's future. Thursday's scheduled meeting came a day before Trump is due to welcome Japanese Prime Minister Shigeru Ishiba. Former President Joe Biden had blocked Nippon Steel's takeover bid, and Trump has also said he's opposed to a sale. India has vowed to curb illegal immigration to the U.S. ahead of Prime Minister Modi's scheduled meeting with President Trump next week in Washington. More than 100 Indian citizens were deported from the U.S. on Wednesday, with thousands more to be sent back in the coming months. Indian opposition lawmakers have criticized the treatment of the deportees after reports that they were handcuffed for 40 hours. South African President Cyril Ramaphosa says his nation will not be bullied, using his State of the Nation address to decry the rise of nationalism and protectionism. Ramaphosa spoke after U.S. Secretary of State Marco Rubio said he would not attend the G20 summit in Johannesburg later this month. President Trump this week falsely accused South African authorities of seizing private land.
We will not be deterred. We are, as South Africans, a resilient people, and we will not be bullied.
And if you are one of our Bloomberg clients, you can catch up on everything you might have missed, including this interview that just took place earlier on that I am slightly offended I got left out of. But in any case, of course, I understand completely, because I'm the only one in this building that does not need makeup. I am looking perfect all the time without even trying. I'm kidding. One of my friends actually told me once again before that they actually did not know that I used makeup on air. And it took me a day before I realized that was a bad thing. This is Bloomberg. Right, welcome back. So just a couple of minutes before we wrap up the show for the week, and what a way to end it, really. Property stocks on the up amid optimism over stabilizing sales. I mean, we are seeing early signs of green shoots across some of the major markets. Of course, we're still months away from a proper turnaround overall, but certainly seeing activity picking up.
I mean, some might say it might be more than months.
Yeah, build the buildings first.
Towards the end of this year. But, as you say, interesting to see a little bit of optimism coming in. We have seen some improvements. I mean, I think by and large, economists predicting that we are going to see a bottom to the property crisis, but likely in the second half of this year.
Right. I mean, markets look ahead, I think, to Wendy Liu, who joined us earlier from JPMorgan. I think one of the underperforming sectors, understandably so, was property, measured from the peak in 2021. And they've actually bumped it down now to neutral because of potential changes that might be in the offing looking ahead.
Yeah, we really yet to see whether or not as well this sort of program for governments to be buying up stock and so on, whether or not that's really helping. And a couple of key names to watch here. Vanka, a name that we really originally, or seemed it looked like it was a survivor. Looked like the authorities were going to step in and help. What really happens there? Also, some of these sort of stronger players like Greentown, issued a profit warning. It's an indicator of whether or not some of these stronger names are going to be able to actually survive all the way through. If the government has done enough. It's an interesting sort of, I guess, a way of sort of taking the temperature here.
It is a dichotomy that markets will need to sort of digest, because we're going into earnings season. Do expect some numbers to look really, really bad.
Sure.
But at the same time, some of the forward-looking indicators might start to look good. In the meantime, though, to the point we were making earlier with Rebecca, that, we are in the midst still of a lot of these restructurings, right? And a pulse check really of that long list of names that haven't even gotten to move the needle on some of their debt issues are concerned. I guess we can table that for another time. That is, of course, a fairly complicated topic. Back to the here and now. This is really the group of stocks that's leading this rally across Chinese tech and duration names, if you will. When you look at the broader Hang Seng Tech gauge, for example, and who would have known just as recently as the turn of the year to 2025 that we'd be talking about a bull market. Yet here we are, right? We're up 22% now from the low that we hit back in mid-January, January 13 to be exact, and we're now just 5% away from the peak that we hit back in October. This is the Hang Seng Tech gauge, to be more precise. So yeah, we'll see whether this rally can last. As Mark Cranfield was pointing out earlier on, it's Chinese tech. That's really pushing the needle here.
To your point, though, part of this story is going to be March, right? We're now on to looking at the meeting. So we have this sort of tariff thing. It's almost in the background now. All eyes really focused on what we see in terms of stimulus. If we see this continued sort of government backing of sectors like tech, this idea of self-sufficiency continuing to drive cash, really, into markets.
Yeah, we're almost a month away from that. In fact, no, we're about 3 weeks away in a couple of days here. That's March 5th, of course. Mark your calendars right now for the two meetings taking place in Beijing. We will leave you with a look at the Hang Seng Index as we move into the latter part of the morning session, about an hour left.
Happy Friday.
Happy Friday, yes, we almost forgot. And yeah, as we go into the weekend, we'll leave you with a look at some of the other items in the agenda today. So we're done here, but suffice to say, markets still have a lot to digest. We have an RBI decision coming through in the next couple of hours. We have a blog ongoing right now on your terminal for more context and analysis. And of course, after this, we then move into the jobs report coming through later today. Flip the page, and there we go. We have another one in that. So stay tuned for that. And yeah, Tia Live we go for commentary analysis from our expert editors here on the show. That's it from us here on the China Show. Happy Friday. Have a good weekend. We'll see you all on Monday. Insight with Haslinda Amin is just ahead.